Our hedged ETF portfolio is doubling the returns of the S&P 500 since the beginning of this year, and folks, with 78% less risk. You don't want to miss this. Yeah, we love this market. And folks, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And folks, we're killing Warren Buffett right now. And let's look at the technology sector, because this has not been a good week for the market. And this is last week. So we were looking at the portfolio last week, and this ETF, the technology ETF, was testing its 50-day moving average, and it did not look good because this up here, this indicator up here, was pointing down. So let's look at this week, and this is as of Friday. Yeah, it fell right through that 50-day moving average and on the way down. The bad thing is that down here, this is our intermediate term indicator. It is turning down. And folks, look at these red vertical lines in here. These lines represent, the red lines represent the market on, or this particular ETF on the down day. And you can see that the red is really starting to build up. And this is just a half a day on Friday as I'm recording this. So it doesn't look good in here, folks, for at least a little while until these indicators bottom out a little bit. So we're going to have a tough couple of days next week. And now we're at the Semiconductor ETF. And folks, this was last week. And last week we were looking at this indicator or this line of support right in here. And we said, this does not look good. It broke that line of support, and we don't care for that very much. Also, this blue line, 50-day moving average, red line, 200-day moving average. If the blue line crosses over the red line, it's called a death cross. And when you talk about the stock market, you don't want to hear that word. Let's look at this week. Well, that crossover happened, folks. So this is the Semiconductor as of Friday, October 20th. And yeah, we broke through that support line. For the past 3 days of the week, we got that nasty death crossover, and this intermediate term indicator is pointing down. So the semiconductors don't look very good, and this is our favorite ETF, or one of our favorite ETFs, and we're having a difficult time, even though we're up strong for the year, and we'll show you that in a minute. Okay, let's look at these. Don't get confused here. These are the 6 ETFs that we like. And what we do is we take 5 or 6 stocks out of these each ETF, and we use the clean surplus methodology. And you've seen our video, so you know what that is. We take the 5 or 6 or 7 most efficiently operated stocks in each ETF, and we call them our top stocks. And so for the XLK, and remember that's the technology index, and we're looking at this about the beginning of September, and then also as of Friday, October 20th. So we're looking at almost 2 months in there. And the XLK was up 41%, and right now as we speak, it's up 31.9%. Now, our top stocks were up 42% at the beginning of September, and now they're just up 31.9%. But our long-short strategy is to buy the top 5 or 6 stocks and then go short the ETF itself. So we're long the best stocks, and then we're short the ETF. So how much did we make for the entire year? Nothing. Okay, but let's go on. Let's go to the semiconductor. The semiconductor ETF was up 19.5% at the beginning of September. Right now, it's up 7.4%. Even that ugly chart that we saw just a few minutes ago, we're up 7.4%. Now, the top stocks in that semiconductor ETF were up 60.8%, and right now, as I'm recording this on Friday, are still up 43.6%. So that ugly chart that we just saw, let me go back to it. This ugly chart in here, yeah, is up 43.6%. Now, if we were long our top 5 stocks and short the ETF itself, we would be up in a hedged portfolio 36.2%. Transport, we're looking at the same type of thing. Transport has fallen since the beginning of September. The top stocks have fallen since the beginning of September, about 14.5 percentage points from 44.7 down to 30.1. And our hedged portfolio, which is long the top stocks and short this ETF, up 24.5%. So they fell, while this ETF fell 14.5 percentage points, we only fell 3.3 percentage points. Home builders up here, let's go up here, down 11.6 percentage points. We are actually up 1.5% in our hedged portfolio. Home construction, down 21 percentage points. We're only down 1.4 percentage points in our hedged portfolio. And again, with healthcare, it's down 6.4%. And we are down 3%. But folks, for the year, we're up 14%. We are outperforming not only the ETF itself, but we're outperforming the S&P 500. So let's put them all together, folks, and let's see that the top stocks dropped from 27.5% to 21%. And the top stocks dropped 13.7%, and we dropped only 1.6%, with the S&P down 7 percentage points. So you can see a hedge portfolio in here while the market is down, and a long portfolio only is down. Market is down over here, and we are only down 1.6%. But for the year, so this is just from September, for the year, we are up 21%, with the S&P up 10%. And don't forget, we have 80% less risk than the market when you put all these numbers together. I know I was showing you a lot of numbers, but folks, it's better to be up 21% than up just 10% for the market and down for some of those other stock portfolios that are out there. So being up 21% for the year is very, very nice, folks. And if you weren't hedged, you're up 27%. And the market is up, what? Only 10%. So yeah, no matter how you do it, if you pick the best stocks, you're going to win out, but you have more volatility. If you want to hedge, it looks like we're doubling the S&P 500 with about 80% less risk. And let's look at the XLU, which was the utilities, and people try to hide in the utilities. And folks, last week we showed this, and it was on a run up. It was this very nice rally, but then this week it caved over and is going down. And when we look at year to date, black line is the S&P 500 up about 10%. The XLU, which is the utility sector ETF, is down about 16-17%. So that's not a good place to hide. Let us look at the healthcare sector, and we can see, well, the chart looks pretty bad. It looks like it's turning over. But let's look at the whole year. The whole year, it is down just 5%, while some of these other ETFs are starting to fall, and a lot of stock portfolios have fallen. But don't forget, our hedged ETF portfolio is up 21%, while the XLV, which is the healthcare ETF, if you try to hide there, you're down 5%. If you try to hide in the XLU, you're down about 17%. Folks, we would rather be hedged and be up 21% with much, much less risk than the market itself. Okay, folks, we had a tough week this week. Go out, enjoy the weekend, go to the beach, walk on the golf course, sit and watch television, whatever you want to do. Take your mind off the market, because guess what? It'll be back here on Monday. All right, folks, stay safe. We'll see you next time.